Moving over to South Korea today, some news there with regards to the financial sector. The South Korean government is creating a $15.1 billion US fund to help recapitalize its banks. There are some strings attached, however. The financial services regulator wants banks that tap into this fund to show that they're using the money to provide loans and to boost capital levels. Daniel So is regional economist at Forecast. He joins us now for some analysis. Daniel, how badly do the South Korean banks need this money?
Actually, if you talk about the capital base, right, South Korea banks' capital base are pretty robust. So the main aim is to even strengthen it further so that they will stimulate lending. But I see at first blush this package looks promising, but the actual impact may not be so significant because the banks, looking at the rising corporate rates, they are unlikely to extend credit freely to that cash-strapped SME. Definitely not.
Daniel, it's Brian here in the United States. It seems like a dangerous proposition to try to force them to lend. What are your thoughts on just the whole concept?
Similar to China, the government tried to force the lending, but in the end, all the China banks actually buy rediscount bills. So I see no impact that of this funds to work really well in the near term, because banks are, as I mentioned, are unlikely to lend, are unlikely to extend credit because rising default risk, and 50% of their balance sheet is already extended loans to SME, and is pretty dangerous right now. So I don't think this is going to stimulate lending.
And Daniel, what's your outlook for rates there, and in relation as well to the Korean won?
The interest rate have to hit down fast, because if you look at inflation expectation is falling fast. So in order to ensure real interest rate hit down, and the rate cut may be a bit too late and recession is on the cut, so I'm looking at a 2.25% in 2009, maybe lower. But South Korea will try to use other administrative measure, more forceful measure, because if you look at the past experiences, if you look at the past recent session, interbank market rate are still sticky downwards, so there's a limit that a lower policy rate can do.
At the same time, we know that South Korean banks have had a very hard problem getting access to dollar funding.
Exactly.
From your perspective, has that eased up a little bit for them since they had that currency swap with the Fed?
With the current 30 billion currency swap, and also they are preparing to inject 55 billion in the first half of 2009, I see that the forex liquidity crunch may not worsen, but that does not imply that it's going to improve. So it's going to be pretty in a bad state. So this will help to, in other words, it will actually limit the gains in the won.
Okay, Daniel, thank you for joining us today. Daniel So, regional economist at Forecast, joining us here in Singapore.